So that concludes our Investing for Beginners series. We covered understanding your investments and the risk that comes with it, broke out different types of investments, building a diverse portfolio, brokerage accounts, short-term versus long-term investing, and of course, setting those goals in the investment community. So go ahead and enjoy the video, guys. This is the entire series all put together. Let me know in the comments what you guys think, and if you find value of the videos, consider subscribing to the channel, and I'll catch you in the next video. If you've ever wanted to build wealth, it is about investing. It is about the time that you have in the market, not timing the market. Today's video, we're going to be looking at the investment risk, and this is going to start off and kick off the new series that we're doing, covering investments in their entirety. Now, when it comes to investing, there is a lot of different risks that you really have to keep in mind when you're putting your money into a market, whether it be in a 401k, whether it is in an IRA, or if it is something in just a brokerage account, starting with the market risk. So market risk overall is going to be the fluctuation of the market. There are going to be up days, there are going to be down days, there's going to be economic conditions when we see rising rate environments. A lot of time the stock market might not perform as well. There can also be geopolitical events. There can be market sentiment depending on the companies. Even if a company you're investing in has a lot of negative publicity, or if something catastrophic does happen within that company, you can see your stock or your investment drop significantly. But it is the same thing on that flip side. If a company does exceptionally well, has a new product, service, is winning awards, things of that nature, you're going to see your investment go up and go up considerably. Number two, we look at the volatility. This is really the price fluctuation of an investment. This is where, for a lot of people, it is very hard to stomach. When you're looking at more of the companies that are, on the S&P 500 that are larger companies, the stability doesn't change that much within the price. There is going to be fluctuation. But if you look at things like cryptocurrency can vary wildly and greatly. It is the Wild West when it comes to crypto. A lot of them, again, if you're looking at the Bitcoin at 60K and then it was at $18,000, that is massive, guys. If there was a company that actually had that kind of volatility, it would be crazy to see. I know, again, there are smaller companies that go up and down, but a majority of the stability of the larger companies are there. Number three, we look at liquidity risk. This is what can be bought and sold in the market in a very fast or slow pace, depending on what it is. Now, if you're investing something into the market, it could take a couple days. If you're investing in bonds, it could take a little bit longer. But if you look at things like cryptocurrency, if you look at things like Masterworks, if you look at things like REITs, there could be specific, depending on the company, that you have to hold the investment. Even when you look at CDs, they're not liquid without paying a penalty. If you look at annuities, if you look at a lot of different investments that we're going to be covering over the next couple of videos, there is a liquidity risk on how hard it is to buy and sell. And also, if you do have to sell it, what is the price impact of that sell? So if you buy something at $100, all of a sudden it goes down to 40, you sell it at 40. Do you have to sell it at 40 to take really the realized loss? Or can you hold on to it till it goes back up? What do you feel? And again, this is the part where it really takes a knowledge and a real stomach to invest in the market. Because if you sit there and watch your investment actually depreciate or fall in value day after day after day, a majority of people will just go ahead and sell it out at that time, and then they will be out of the market in their entirety. Now, we also do have credit risk. This is something where if you buy bonds from companies, if you look at government bonds, they can carry a different level of credit risk based on the issuer and the financial health. So when a lot of people talk about possibly downgrading the United States economy, guess what? That could make it a lot more difficult to sell government bonds, which I don't think has happened at this point. But again, there's always kind of rumors, and the same with companies. If you have a company that is, double A or triple A rated with the credit bureau, or an A+ rating with the Better Business Bureau, all of a sudden something happens, it goes down to a C. If you do hold those bonds, chances are it could be a lot more difficult to get rid of those. So you're not only relying on the credit risk that you have or the credit that you do carry, which isn't going to be affected, but looking at the credit risk of who you are getting the money from and you're buying those bonds from. There's also a big thing that a lot of people are focused on right now, which is number 5, the inflation risk. Recognizing the impact of inflation of the purchasing power of money. That is right, guys. Investments with returns that do not outpace inflation will lose real value of money. Now, a lot of people, again, do not really understand this. So if you're putting something into, let's say, a CD, and your CD is paying 2% and inflation is running at 4%, even though you're making 2% on your money, you're only covering half of the inflation that you're kind of subject to. So as you're buying things, you're actually spending more money, which means that your investment needs to be making 4% or higher for you to be net positive. And again, big picture thinking, this is something you do have to keep in mind. Interest rate risk is the next one that we look at number 6. Interest rates can be drastically different, guys. Even looking at the beginning of 2022, 5-year CDs were paying about 0.6%. Now you can look and you can actually get a 5.5% or even 6% investment that is guaranteed in a CD for about 9 months. So it's kind of crazy to see that the 5 years was at a 0.6. Now we're seeing 9 and 12-month CDs at 5.5, 6%. That is the impact of really the interest rate risk that you're running. Lower bond prices can really drive down the interest rate as well. A lot of people deal with treasury bonds. Again, that can fluctuate pretty well when it comes to the rate. Number 7, we look at the political and the regulatory risk. Again, that is something that is huge when it comes to the crypto community. Even looking at the possibility of Coinbase leaving the United States because of the regulation that is going on. That, of course, would have a huge impact when it comes to cryptocurrency, the ability to trade it, and even some countries that have banned cryptocurrency with the buying and selling going outside of the United States. I know most recently, KuCoin had the KYC verification. If you're in the United States, unfortunately, you cannot verify unless you VPN. So there is regulation that has literally pushed a lot of those cryptocurrencies off of shore. Number 8, we have currency risk. Now, this is, of course, the fluctuation of currencies within an investment. This can be relevant if you're looking in international markets. If a country goes to war, who knows what could go and what could happen to your investments overseas. It is something to keep not only the currency risk, but also the international investments in mind when you're doing this. Diversification is the final one, guys, which is my absolute biggest one. This is the reason exploring the benefits and spreading your investments across different asset classes will reduce your diversification or increase your diversification, but it will also mitigate your risk. Now, what do we mean by this? When you look at the stock market, there's a bunch of different sectors that kind of make up the stock market. If one sector, let's say technology, has a huge impact negative where technology stocks start to plummet, you could have other sectors within the S&P 500 if that's what you're investing in. That is going to be able to carry or make up some of that risk or spread out some of that risk. This is where a lot of people say, if you're looking, again, big picture at portfolios, if you put some in stocks, if you put some in bonds, if you put some in, let's say, real estate, you put some in cryptocurrency, you put some in fine art, there's a lot of different ways that you can diversify a portfolio to really make it and minimize the impact while continuing to growth and while continuing to earn money within that portfolio. These topics, guys, again, we're going to be covering the investment side for probably about the next week or two. Let me know in the comments what you guys think. If you like the content that I provide, definitely consider subscribing to the channel, and I will catch you in the next video. When it comes to the world of investing and diversification in portfolios, do you actually know where your investments are and what your investments are in? There are a lot of different assets and financial instruments that we use in the investment world, and in this video, we are going to break them down. Starting with our first one, guys, which is equities or stock. Now, this is ownership of a company. When you look at Apple, when you look at Nvidia, when you look at Tesla, you are owning a company or owning fractional shares of a company. This is stock represents a claim on a portion of the company's assets as well as their earnings. That is why a lot of companies do pay dividends, because you are a shareholder of that company. Dividend investing has increased in popularity over the last couple of years to astronomical size, guys, meaning that the company, rather than investing money into the company itself, they are willing to give it into shareholders or giving money back to shareholders that they could have been investing in the company. Not only can you have stocks that grow in value as a growth stock, but you can also have a return on the dividends that those companies do yield. You are actually getting a cut of the profits. Now, Warren Buffett talks about this in saying investing in companies that have a really great track record and also that you believe in. They say that if you buy Coca-Cola, you should drink Coca-Cola or vice versa. If you use Apple products, invest in Apple. If you use Verizon phones, invest in Verizon. There's a logic behind using the things that most people do, especially if it is something that you do utilize in your own world. Looking at number 2, it is bonds. These are fixed income securities that represent loans by an investor to a borrower. Typically, they are corporate bonds and they are government bonds, We know we can buy like EE bonds, you can buy I bonds. There are a lot of government issued bonds. Now, that is how a lot of companies and governments do raise money. Bonds pay periodic interest and return the principal at maturity. So if you're buying let's say a bond that is a 10-year bond, after 10 years, they are going to give you the value of the bond back depending on what it is. In addition, they are going to pay you interest periodically. Some of them do not actually physically pay the interest in the case of a government bond. Until you cash in that bond, you get the principal back that you put in, plus you get the interest that was accumulated. But be careful with bonds, guys, because you still have to pay taxes on those. Now, depending on the rate that the bond is paying, it also goes kind of hand in hand with the risk. If it's a much riskier company, if they're looking to raise capital through bond or the sale of bonds, they are going to be a lot paying a much higher interest. But again, the risk is going to kind of go hand in hand with that. Number 3, we look at mutual funds. Now, this, I know Dave Ramsey, mutual funds is the way that he always goes, and that is kind of what he preaches. Examining investment vehicles that pool money from multiple investors to invest in a diverse portfolio of stocks, bonds, and other securities. So this is actually a managed fund where people are managing the funds. I know a lot of them have robo-advisors, things of that nature now. And I don't know if it touches mutual funds because I believe at this point it is still exclusively people that manage the portfolios with stocks and bonds, other securities that are in there, making up a mutual fund. Now, you have to be very careful with mutual funds, guys, because they usually do come with a much higher cost average. So when you look at a regular stock like the VOO, it is a 0.03, which is the expense for that. Mutual funds can be much higher, especially if you're incorporating a financial advisor, which most of them baseline take about 1% on good years, 1% in bad years, which can account to 20, 30, 40 years. Could be a very substantial amount, depending how much you have invested, of the profits that you could have. Number 4 is the exchange traded funds, or the ETFs. These are my favorite, guys. Even though I'm not a financial advisor, this is what I invest in. So understanding investment funds that trade on the stock exchange, very similar to stock, it is ETFs. So instead of buying one specific stock, again, looking at Apple, looking at Tesla, looking at Nvidia, instead of buying one specific stock, I purchase personally the VOO, which tracks an index or a basket of assets and provides diversification. When you look at the VOO, it invests in the top 500 largest companies, which I believe last I looked, there were like 522 in there, but it does look to track the S&P 500. So I'm actually tracking an index instead of a specific performance of a stock, which a lot of people do. And again, looking at ETFs, guys, it seems like they are a much lower risk because of the diversification factor that you do have, but always do your research before you invest in anything. Make sure, guys, you do your research. You know the companies that it's going into. Even looking at ETFs, don't base everything just on previous year's performance. Make sure you understand exactly the direction that they are headed. Number 5, we look at real estate. This is the investment in physical property, if it is actually owning it yourself, residential, commercial property, or it can even be generated through different REITs. Now, REITs is actually a company that puts together a bunch of real estate portfolios. I've used Fundrise in the past, which does have REITs and a bunch of other things as of now. But the real estate can generate rental income. The rental income can also pay for the property itself. In addition, with real estate, there can be a lot of downsides, which again, you really have to look into, but also it can go up and appreciate in value. If you're buying a home that's $150,000, you're renting it out. The person that is renting the house is paying the mortgage, covering all the expenses that you cover, and the appreciation value of the house is going up as well. Number 6, we look at commodities. This is really looking at physical goods as gold, silver, oil, agricultural products. Investors can gain exposure to commodities through various financial instruments. These I'm not too familiar with, but I know there is gold ETFs and things that you can buy. There are also physical gold, guys, which is kind of crazy to think. So if you're hoarding gold bars in your basement, let me know in the comments down below. Just kidding. But a lot of people do buy the physical product and hold on to the actual physical product instead of just having the investment. But it also means that if you're looking for liquidity, you're going to have to actually find someone to buy the physical merchandise that you have. I don't know how many of us are stockpiling oil in our backyard, but overall, gold and silver is one that I do see quite a bit. Number 7, we get into cryptocurrencies. Now, these, of course, are the digital and virtual currencies. Bitcoin, Ethereum, when used, the cryptography for security and operates on a decentralized network. Now, of course, this was the big hype a couple years ago. It seems like a lot of people have pulled money out of cryptocurrency. A lot are still invested. I know there's a lot of utility tokens, things of that nature. Personally, again, my opinion, looking at Bitcoin, looking at Ethereum, that is what a majority of people are really in. There's a lot of kind of speculation when it comes to cryptocurrencies, especially when it comes to newer coins, meme coins, things of that nature, or some coins that really don't have any utility at all. So again, this is another area you do want to do your research, do your due diligence, and make sure exactly what you're doing. Number 8, we get into options, understanding financial derivatives that give investors the right, but not the obligation to buy or sell at a specific price within a specific time. Again, this is an area that I'm not really familiar with the options. I've heard it, I've researched it, I've studied it. Options trading is what a lot of people do. So they'll buy it and they'll buy it in a different manner where they hold it for a certain amount of time. And then either they're predetermined if it's going to go up or if it's going to go down. And they have to kind of cover the difference if it does go up or down. It's almost like betting. Now, cryptocurrency, I've seen this exact same thing. Where you can actually leverage and buy it on options. And it just gets insane with the amount of money that you can borrow on a portfolio that you have. But if you have to pay it back, guys, again, be very careful with it. Number 9, we get into the preferred stock. Now, this is examining a hybrid security that a character has both common stocks and bonds together. Preferred stocks received a fixed dividends before the common shareholders and have a higher claim to assets if there is liquidity issues within the company. So this is kind of a stock that is kind of the preferred or the better version of a stock. So if they're only paying, let's say, a premium or a dividend to the preferred stockholders, they're not giving away any money to the common stockholders. And also, if you are looking to sell your shares, the preferred stock will actually get paid out first if the company is going bankruptcy, like we've seen with Bed Bath & Beyond, Toys R Us, Kmart, things of that nature. If there is a liquidity or a liquidation of the company, the preferred stock will have, if there is anything left. Now, looking at number 10, we look at retirement accounts, guys. Now, these are your 401ks. These are your IRAs. These are your tax advantage accounts that you have to be into if you ever in your entire life plan to retire. And hopefully there's going to be a time and point in your life where you want to retire or you have to retire. These accounts offer tax deductions or tax-free growth. Make sure, guys, that you're exploring the Roth options with these, especially if you are a younger generation. If you're really close to retirement, might not have a time to make a big difference, but still putting money in that Roth would be beneficial. But overall, guys, the longer time that you put money in your Roth, the longer that you do have it to grow, you will grow tax-free, which is huge, guys. Again, if you're putting money into, let's say, a Roth 401k, you let it grow for 40 years, making regular contributions. Everything you have in there is completely tax-free, which is what you want. Now, we also look at some of the different options as peer-to-peer lending, hedge funds, and of course, the CDs. Peer-to-peer, we see this through a couple different places. This is alternative investments where you can actually borrow from other individuals. So people will actually put up their money for someone else to borrow it. And again, this has a big risk part to it, which means you have to be careful. You have to do your research. Now, I know there is some automotive lenders. There are some kind of like payday advance lenders. There's a couple different places that do, and I have seen this through lending, that they do the peer-to-peer lending. Now, hedge funds, this is pooling funds in a various strategy and returning money to their investors. It says that a more flexible investment strategy compared to traditional investments. Again, this is taking a bunch of money and pooling it all together to make the investment at a much greater magnitude because you have more money to go in there with the hedge funds. And the last one, guys, is the savings accounts, which the high yield savings accounts are still popping up absolutely everywhere. And also the certificate of deposits. Both of those are very low risk. They're interest-bearing accounts. Some of them do pay on a quarterly basis. Some pay on a monthly basis. So again, do your research when it comes to those. We have CDs right now that are paying 5.4%, which is pretty darn good when you look at the average return of the stock market. And remember, those are guaranteed, guys. Same with the savings accounts. Most of them are FDIC insured or NCUA insured, depending if it is a bank or a credit union. But also, again, do your research. I cannot stress that enough. When it comes to portfolios, when it comes to investing, we're going to continue down this journey, guys. This is the second episode of the investment portion. We still have 8 more that are coming. So guys, if you like the content that I provide, go ahead and click that subscribe. Let me know in the comments what you guys think, and I will catch you in the next video. When you think of your investment portfolio, how diverse really is it? When you start breaking down what is in your 401k, what is in your IRA, you want to make sure that you have a lot of diversification, which is what we're going to be going over in this video today. The first one we look at when it comes to the diversification is asset class diversification. This breaks down stocks, bonds, and cash that is spread into your portfolio. This means that you're not sitting on 100% stocks, you're not sitting on 100% bonds. Now you'll notice with some of the age-based programs or some of the target age dates that we see from Vanguard and a couple other companies, that they are a majority very, very heavy in stock. Now this will switch depending on how long. So if you're looking at, let's say for instance, a 2065 plan, the chances are, because it is many years out, that the majority of it is going to be in stocks and you're going to have a very small part in bonds, very small portion of cash. Now, as you get closer to retirement, so let's say you're in a 2030 plan, and right now we only have a couple more years until the year 2030, chances are the stocks are probably a little bit lower, and the bonds, they have started to pick up to yield that income every single month. Now, make sure, guys, again, that you're really looking at the asset class diversification and making sure that you do have it in there. But there are a ton of ways to diversify. Also with geographic diversification, it removes or moves your investments, essentially different regions, different countries, to reduce the risk associated with a specific location. Now, we see this a lot where if all of your investment portfolio in its entirety is all US based, you have no international stocks, you have nothing that is outside of the United States. If something should happen here, if that is where all of your funds are at, the chances are you could have a very high risk factor if something does happen to the market, where we could see some stability in other countries. Now, locally, we've seen, kind of COVID affecting the world. And as of now, guys, we've seen the United States kind of in a very good spot economy-wise as we continue to get inflation under control. If you look at other countries, if you look at other regions, there are places where inflation is just burning up every single penny, where the currencies are almost folding. It is kind of crazy to see, how much stability we really do have here in the United States in comparison to some of the other countries. And of course, we're not number one by any means, but we do have a well sought after and well diverse income stream that we have with the sectors within the stock market. Next one we look at is just that, guys. It is the industry and the sector diversification. This is super important, and this is especially important when it comes to some of the sectors such as technology that can have a really big high ups and downs, making sure that you are spreading and diversifying that portfolio. Again, talking about it all the time, this is the reason I invest in the VOO. It actually takes all of the sectors of the indexes the S&P 500, really diversifying across every single sector. So if you have a certain sector that underperforms or has something catastrophic, like we've seen with the banking industry, with a couple of banks failing, a lot of the sectors or that the financial sector did take a pretty nice hit when that did happen, but it was picked up by a lot of the tech sector and a lot of the other places that really made a difference, which is the reason if I was solely invested into one specific thing, let's say I was 100% into technology's seen a 30%, probably 30% plus decline in 2022, which could have a massive effect on your returns when it comes to your investment portfolio. Number 4, we look at the market capitalization diversification. This is breaking it up. Now, a lot of 401k plans that you have with your employers do have the ability to do this. So this breaks it between large cap, mid cap, small cap to really balance the risk and the potential rewards that you can actually get from the portfolio. If you're putting everything into large cap, again, we might not see, and we do not see the growth when it comes to large caps, just because you're talking about massive companies. You're talking the Apples, the Teslas, the Googles, the Walmart, all of the large companies that are in the United States are large cap that are trading. And I believe, if I'm not mistaken, it's north of 100 million. Maybe it's a little bit higher. Maybe it's 100 billion that I'm thinking. But then the mid cap and the small cap, those are usually the sectors that can have a tremendous amount of growth. So again, depending on the cycle of the economy and where we're at, mid caps and small caps, it's good to have a good diversification. Now, overall, when I look at kind of a balanced portfolio, you might do 40% in like the large caps, you might do 20 in the mid caps, you might do 20 in the small caps, bringing you up to about 80%, and then looking at possibly, if your 401k allows, doing some international, doing something a little bit more riskier, maybe a little bit more outside of the box. Now, I'm not an investment advisor, guys. I'm just speaking from experience in working with multiple investment advisors, seeing how they really broke out the large cap, the mid cap, and the small cap. Really, most of them will bring it to 80% or 90%, and then go with that rest of that into that international. Number 5, we get into the risk tolerance. This is super, super important, guys. When you're taking assessments, when you're doing investing, not only do you have to do your own research, but you also have to know that there is a fundamental risk with the portfolios, guys. They are going to go up, they are going to go down. It is not about timing the market, it is about time in the market. Really, if you live by that, if you're looking at retirement, if you're 20, looking at 65 in retirement, you have 45 years to go, the ups and the downs, really taking it. That means at a younger age, you definitely want to take on more risk, because if something does happen where you do lose a considerable amount of investment, you do have a long time to make up. And even if everything goes south and you lose all your investment for whatever it may be in, which usually doesn't happen, but you do have time to make more money and to reallocate and reinvest to really build up. Live and learn, guys. It is really one of the big ones, but make sure you're not taking unnecessary risk and you're not taking risk with a huge part of the portfolio. Personally, when I look at my cryptocurrency, I know it is a high risk and I am okay with that, but I allocate about 5% of an investment portfolio into cryptocurrency. So it does keep it very minute, where even if the Bitcoin and the Ethereum does, go down a lot, up a lot, whatever it may be, guys, I still have that 5%. That way I know my risk tolerance is really good. Number 6, we look at the correlation analysis. This is really looking for the historic relationships between assets, because a lot of them do not move in tandem, guys. A lot of times, if we see a big decline in the stock market, we'll see an increase in the bond market, because money is moving hands. That is exactly what was happening in the crypto market, where a lot of people were pulling money out of the stock market, were pulling money out of investments and moving it into cryptocurrency. And then, of course, we've seen the flip side of that, where a lot of people were taking money out of cryptocurrency, which drove, of course, the price of Bitcoin from like 62K to like 30,000. I think at one point it was even down to 18, because they were selling and taking all of the money out of the cryptocurrency because it was and had a much higher risk. Number 7, we look at the investment style diversification. This is another one, guys. Again, big fan of Dave Ramsey. Shout out to him. But when you look at the different styles and the diversification, you want growth stock, you want value stocks, you want dividend stocks. There are, and these do perform in a very different manner. I know he is a big fan of mutual funds, but again, he says put 25% in a growth mutual fund, put 25% into value. He kind of breaks it down into 25, 4 stacks of 25 to equal that 100% of how it should be invested. Now, again, me personally, not a huge fan of the mutual funds because of the costs that are associated with them. I guess when you get to a certain point, it doesn't really make a big difference. If you're investing 10, 15, $20 million, if not more, the fees kind of come minimal at that. But if you're looking like a majority of us, where you might have 10, 20, 30, $100,000, you're not in the millions. You're not paying someone to manage everything that is going on, which is why I rely on my ETFs. I love the ETFs and I always will. And number 8, regular rebalancing. This is one that I wanted to spend a little bit of time on, because when you look at the CEO of Vanguard, guys, he released a publication. I believe it was a speech that he was going about the rebalancing and how technically you should never have to rebalance a portfolio, because essentially what you're doing is your investments that are doing incredibly well are going to grow faster than investments that are not doing as well. So essentially what the rebalancing does is you're taking these investments, because let's say the large caps at 40% are doing incredibly well. It grows that large cap to 45%. The rebalancing act is going to sell that back down to 40% to make up what the mid cap and the small cap is not doing, essentially. So he said, Without the rebalancing aspect, you can let the large cap run, and we're just going to let that run because that is the sectors that is going to perform. Over the long term, the mid cap and the small cap, if they are underperforming, they will either have a smaller percentage or they will start performing at a point that they can catch up to where your large cap is. And again, the rebalancing, I choose not to rebalance. I really let the portfolio, I set my portfolio, I put money into my portfolio every 2 weeks. Through automatic payroll deductions, really have to go ahead and optimize that, doing it automatically with the allocations. And then it is broken into what I have it invested into. And again, I do not do the rebalancing personally. Number 9, we get into the income versus the growth. This is one of the ones, guys, when you look at the bonds, when you look at investments that generate income, this is talking about the dividend investing, the bonds, those versus those that really focus on the capital appreciation, growth stocks. It really is different financial goals, but you can have both. And that is what I think a lot of people really get stuck on. When you look at, let's say, the SCHD, the Charles Schwab dividend fund, a lot of people really support it. A lot of people put a lot of time and effort into it. They said if you want a dividend fund, it's really the only one that you need to be paying dividends on a regular basis. But if you can mix that up, guys, so I have the VOO with the S&P 500, dividend yield really not that big, but if I'm putting 30% of a portfolio in there, I am good when it looks at the large cap because of course it is the 500 largest companies in the United States. I put, 20% in the SCHD. With that, I do get a pretty good dividend yield that is going to grow over time. And I also put some in a couple different places, including the cryptocurrency, in the REITs, possibly looking at Masterworks, things of that nature to really allocate and balance out that portfolio. And the final one that we look at, guys, is the alternative investments. Exploring the non-traditional assets. This is where you get into real estate, when you get into crypto, when you get into fine art, when you get into commodities. There is a big upside, and there is a big downside when it comes to a majority of these guys. So make sure, again, that you're doing your research before you go in here. So I hope that helps with the diversification of a portfolio, really breaking it down as we continue, guys. This is the 3rd video in the series. Let me know in the comments what you guys think about it, and I'll catch you in the next video. So it's time to finally open the brokerage account to get the investing started. But wait, guys, there's a couple things that you do need to know before you get that account open, which results in research. You have to really research and take some time, see exactly where you're going to open it. Now, there's a lot of different places, guys. There's M1, there's Robinhood, there's Webull. There are a ton of online brokerage accounts, not even including what is offered from Vanguard, Charles Schwab. And even if you look at financial institutions, most of them have the same. Looking at Fifth Third, they have investments. Looking at Chase, they have investments. There is a ton of different places. So in today's video, we're going to break down all of the steps that you really need to do in this crucial process before you get into the investing scene. So let's get into it. Number 1, guys, the account type. Now, when you are making an investment account, there are a bunch of different types you have to know, guys, including individual brokerage accounts. These are accounts that are going to be held by an individual. You have joint accounts. So are there going to be more than one person on this account? Is it going to be you and your spouse joint on an account with equal access to it? Are they going to be retirement accounts? Now, this again is something to really know about, because if you're looking at IRAs, if you're looking at 401ks, both the IRAs have contribution limits and they have income limits based on how much money you make. The 401k also does have contribution limits. So you have to be very, very cognizant of those and make sure that you're not going above and beyond and investing too much, guys, because you can actually get penalized. Or are you looking at education savings accounts? Are they for you? Are they for your kids when they're getting ready to go to school, such as the 529 plans that they offer? Currently, where we're at, we have the MESP program, which is the Michigan Education Savings Program. It is a 529 plan, but it works incredibly well. And as we know from previous videos, 2024, they're going to change a lot of the 529 plans to make it a lot more beneficial for you to have them. Number 2, we get into the fees and commissions. This is very important, guys. You have to understand the fee structure of the different brokerage accounts, including trade commissions, account maintenance fees, and any other fees that they may charge. Now, a lot of the brokerage accounts that do have and come with a financial counselor or a certified financial planner, things of that nature, usually charge a percentage. Now, this can be very tricky, guys, because as you go through life and as your portfolio grows, as not only it grows, but as you put more money into it, The 1% can be absolutely crazy when it comes to how much money that they can actually take. When you look at 1% of $10,000, okay, that's pretty good. If you're looking at 1% of 100,000 or 500,000, the fees can get astronomical if they are charging the 1%. Now, in addition, a lot of places do charge the 1%. And then on top of that, they have monthly or account maintenance fees that can coincide with that, meaning that not only are you paying the 1%, is you're being charged a certain fee as a maintenance fee to actually keep that account. Now, also, there could be trade fees. So when you look at the expense ratios of what you actually own, there could also be fees for that, again, depending on the structure. This is why you have to be super careful about the investing, knowing the different accounts and also knowing the different fees they're going to, and also seeing if you can be charged a flat fee. Now, this, of course, is different. If you're going in at a flat fee, you may pay a couple $100 to do all of your trades. Once you get everything set up, then it is good. It runs from there, meaning that you're not going to have that 1% charge. Now, in addition, there are a lot of places that are completely free, guys, and I cannot stress this enough. There are a lot of places that have the fee-free accounts, just like M1 Finance that I utilize, but there are a lot of places that do have no to minimal trading commissions, and a lot of this comes with some of the fintech companies, and it comes with a lot of the online brokerage houses. So unfortunately, you don't have someone to go in there. You don't have a lot of guidance. A lot of places, again, thinking of M1, thinking of Robinhood, you can get kind of pre-built portfolios that they have built into their system that you can just put money into, and it will diversify where it is. But again, do your own research on this, guys. Now, number 3, we get into the minimum deposit requirements. This is another one. Some brokerage accounts wildly vary. Some are $100 to open, some are $5,000, $10,000. We've even seen some of the accounts that have a $100,000 price tag to get your foot in the door to open the brokerage account, depending where it is, guys. Now, most financial advisors look for $10,000 plus, but there are some, again, that go to the $25,000 to the $50,000 range, meaning that you can't even get in the door without having that amount of money. So as a starter account, as you're looking to build up your portfolio and really choose the platform, guys, that has what you need. When you look at, are you going to be trading on a regular basis? How many trades are you allowed? Again, there are a ton of different things. If you look at E-Trade, that is another one that kind of charges fees per trade. So again, that can be a way that if you're doing a lot more trades, it might not be beneficial. But if you're doing 1 or 2 a month, like I do, every time I get paid every 2 weeks, we do a little bit of trading. Might be beneficial to look into something like that. Again, because you know you're only doing 1 or 2 trades a month, it's not like you're going to be doing 3 to 5 a week where those fees can really add up. Number 4, we get into the research and the educational resources. This is the online, guys. When you look at some websites, when you look at NerdWallet, when you look at Bankrate, there are a lot of different sites that will evaluate all of the brokerage tools, seeing exactly what you need and breaking it down with the fees, with the market expenses, everything of that, from research tools, market analysis, educational resources. What is your brokerage account going to provide you as an investor to make informed decisions? This, again, is something that you do have to do a little bit of research. Now, I know, again, because I'm super familiar with the M1 platform, they have a research tab, which is a plethora of information. And even when you go into individual stocks or ETFs or things of that nature, they actually have news articles that are tied to that, meaning that you can do all of your research through there. And all of the research that is conducted through there is actually outside resources. So it is not something that M1 is saying, hey, this is what we're providing you to go off of making your decision. All of the information in there is from external sources. Number 5, we get into the platform. This is super important, guys. Watch some YouTube videos, and I really do recommend this. For the trading platform, the user interface and the functionality, guys, it has to meet your needs and it has to meet your preferences. If you are very clunky with a platform, if you don't like the interface, if you don't like the functionality, and you're looking at it and you're like, well, I wish it did these things, but it does do this. You know, there is some give and take in there to a platform that you really get familiar with, that you're comfortable with. And a lot of them are a lot more basic. But again, you have to know what you're getting into, guys. I know a lot of people that have gotten in trouble in a couple platforms. When you look at doing longs and shorts and things of that nature, you have to know exactly what you're getting into. And number 6, we get into the investment options. Now, this is not the same for every brokerage account that you have. If you can trade in stocks, bonds, mutual funds, ETFs, other securities, you have to know exactly what the brokerage account is going to offer you. So if you're looking to get some of the other securities, if you're looking to, let's say, get into cryptocurrency, if you want a couple percentage into a cryptocurrency, if you're looking for Bitcoin, Ethereum, does the brokerage account that you offer cryptocurrencies, or are they just completely obsolete? What can you get into for stocks? Can you buy individual stocks? What ETFs do you have exposure to? What bonds, what mutual funds do you have exposure to? And again, this is where the research option is going to come in greatly. Number 7, we look at the customer service. Now, this is something, guys, if there's issues with the system, if there's issues with deposits, what does the brokerage account do about it? And what does it look like when you look at response times, availability, efficiency of the problem resolution? Now, again, this is something that is very hard to research short of going and looking at Google reviews, looking at, the Apple App Store reviews. You can kind of get a sense. And again, looking at Bankrate, looking at NerdWallet, there's a lot of different places that rate these apps, and they rate them on a multitude of things. So again, doing your research and making sure that you do have and you spend the time looking at the customer service, because unfortunately, if you're investing and then you get to the point where you need customer service and it's not there, guess what? You're kind of SOL at that point, because unfortunately, you're not going to have the customer service. Number 8, we look at the account security. This is something you have to, guys, making sure that you can protect everything you have in your account, including your personal information, your funds. And does it have two-factor authentication? It doesn't have encryption protocols, making sure, again, that everything is going to be safe. And number 9, is there mobile accessibility? Does it have an app? Now, there are a lot of brokerage accounts that do have apps. There are some that are tied to financial institutions. There are some that are completely independent. And some of them, it's actually very difficult or very basic when it comes to applications, meaning it's not very user-friendly. To find things is kind of clunky. I'm looking around, but they do have an app, but it might be pretty basic for some of the places that you're looking investing. Again, when you look at Robinhood, when you look at M1, they are pretty easy to use, especially as a newer beginner. And the final one we look at, guys, is the regulatory compliance. This is something, again, really just to make sure that they're within regulatory bodies, complies with industry standards, and a level of security and accountability for investors. You want to make sure that the app that you're going through is legitimate, the brokerage that you're going through is legitimate, and also knowing that they are going to be compliant. When you look at a lot of, again, cryptocurrency companies that are now offshore that left the United States, there are a lot of people that can no longer utilize those accounts. Binance, I used for a while. I can't use it anymore. KuCoin, I did the same. I actually had a crypto account with KuCoin. Unfortunately, with their KYC that they're now requiring, I cannot put money into that KuCoin. And the fate is yet to be decided to see what happens with Coinbase. If Coinbase is going to end up staying here locally in the US, or due to regulatory compliance, are they going to move offshore and be actually outside of the United States, which would be absolutely detrimental, because I believe that's one of the only ones that are still here, again, because of that regulatory compliance. So guys, that will do it for today's video. Let me know what you guys think about the brokerage accounts, and I'll catch you in the next video. When it comes to an investment, do you have 5 days? Do you have 5 weeks, 5 years, even 50 years, guys? Today's video, we're going to be breaking down the long-term and the short-term investments. Really, the investment horizon is the big thing you have to look at, and knowing exactly what you're going to be investing in. If you're looking at the stock market, it is a lot longer term. If you're looking at CDs, things of that nature, it is really imperative that you think about this. And you can also have both things. You can have long-term investments, you can have short-term investments. And again, this is going to range from a couple days to a couple years, depending on exactly what you're looking to do. Now, when it comes to retirement, that is going to be, of course, a very long-term investment, depending on your age. But again, if you're looking for an investment goal of saving for something, or if you want to invest in, let's say, a home, the investment horizon might be a lot shorter, and that can make a big difference on how you invest. Number 2, guys, we look at our financial goal, aligning investment strategies with specific goals. Long-term goals are associated with retirement, or short-term might be focused on more immediate needs or opportunities if you're looking to get into the market. Most of the time, when you look, again, at stocks, bonds, things of that nature, they are a much longer time horizon, which means if you're looking for short-term goals, it could be looking at high-yield savings accounts and CDs. Like I said, it's something that you don't want to have a ton of volatility with, because if you put money into a short-term strategy, it goes down 30%. Now you could be in trouble financially because of that investment, not being able to hit those goals because of the decrease of the value of that asset. Number three, we look at the risk tolerance. This is, of course, something that is hugely different, guys, between the long-term and the short-term investment. Short-term is very sensitive to the market volatility because you are going to be in there for a very, very short amount of time, where when you look at a longer time frame, I'm thinking 5, 10 plus years. When you look at the market, guys, it yields about an 8%, 8 to 10% return on average. Now that, of course, is over a specific amount of time, but that is the average. So when you look at some of the short term that you're seeing, the 2%, the 3%, even the 5%, the market will over time yield a much better result, which could essentially be gone if you're not investing in the market. Now, most recently, a lot of people were saying they didn't want to invest in the market because the market was down. The market is not performing well. Now's the time, guys. You don't want to buy when the market is going up. You want to buy when the market is already down. It is really not pull your money out as it goes down. Keep the money in, put more money in. They always say when there's blood in the streets, you want to go ahead and be purchasing what is going on. Number four, we look at the asset allocation. This is kind of what we talked about. When you look at long-term investing, dividend portfolios, stocks, bonds, things of that nature, short-term, you're looking at more liquidity and more and less volatile because, again, you don't have the time that you're putting in the market. This means that cryptocurrencies are, in my opinion, a long-term investment. A lot of people do hold them, but there are a lot of people that do trade them on a very short-term really timeline, but that can be very, very scary, especially if, again, we see a major decline in the market like we have. Market timing is number five, guys. When you look at the market timing, this again is very important. Really living by the philosophy, it is not timing the market because that is near impossible, but it is the time in the market. When you look at a short-term investing strategy where investors aim to capitalize on short-term price movements, meaning that if you have a stock at 30, it goes to 32, you sell at 32, vice versa. If it goes down, then you can either short it or you can buy it when it goes down. A lot of people will play the market that way. Long-term investments adopt a buy and hold strategy. Personally, that is what I do because I don't have enough time to really invest into short-term market fluctuations. Buying essentially Bitcoin at 16, selling at 20, buying at 18, selling at 22, as it continues to fluctuate through the market. A lot of people do make a lot of money, but again, it is a lot of time that you're putting into a strategy like that. Number six, we look at the portfolio turnover. This is really when you're buying and selling assets within your portfolio. Short term will have a very high turnover rate, more transaction costs. This is very important, guys. If you're trading multiple times a day, like a lot of people do, especially with cryptocurrency, when you're doing the trades, when you're doing the buys and the sells, there are fees associated with every single transaction cost. Long-term investors like me, I put it in every 2 weeks, and that is it, guys. I do 2 buys per month if there's 2 pay periods during the month, and that is it. So my transaction cost is much lower than a strategy of short-term investments with a lot of buys and sells. Always have to remember number 7 is the taxes, guys. Short-term investment capital gains rate is very depending on how you hold the investment. If it is a short-term hold, you are going to be subject to a higher tax rate for capital gains. If you hold it, I believe it is a year or greater, you're penalized or you pay less of a tax for an investment that you are actually holding for a considerable amount of time. Now, number 8 gets into the 8th wonder of the world, which is the compounding interest. Compounding interest over long-term investments is just incredible, guys. If you've ever done some of the compounding interest calculators, look at putting, let's say, $10,000, $50,000, $100,000 into an account, compound it for 30 years, you'll realize you have a couple $1,000,000, which is kind of crazy to think. Compounding returns can significantly increase wealth. In my opinion, this is the only way, probably one of the biggest ways, guys, and one of the only ways to generate sustainable wealth over an extended amount of time. Even if you're a real estate investment, taking some of the earnings, putting into somewhere with that compounding interest. If you're an investor, putting it into somewhere that is having returns. Even looking at the crypto market, guys, especially with Ethereum that you can stake, getting a return on your money that you already have invested is huge. Now, of course, you're going to completely mitigate this, or it is really less pronounced in short-term investing. If you're not holding it, you're not going to see the dividends. You're not going to see the compounding effect. Number 9, we look at monitoring and adjusting. This is one of the big things, guys. You have to look at market trends. You have to look at news. Long-term investments have a very hands-off approach. That is exactly what I do. Is I came up with a strategy broke it down systematically, put money into that strategy, including some cryptocurrency, including a couple other things, including REITs. We have the VOO in there, of course. We have the SCHD, the Charles Schwab dividend fund. We have a couple in there that I've really picked out that I systematically put money into every 2 weeks, regardless of what is going, because it is a buy and hold strategy that I do have. Now, short-term investments, you have to stay really in touch with everything, guys. If there is something going on, such as a war, we could see the markets go up. If there's something detrimental to a company, you could see it bottom out. You could see, when we just seen Bed Bath & Beyond declare bankruptcy, they are out of the market. Number 10, we look at psychological factors. This is one of the biggest impacts that I see, guys, is when you look at the psychological factor. If the market's going down, people rush to sell, driving the market further down. Those are the best buying opportunities that I see. And again, looking at Warren Buffett, looking at a lot of the great investors, as the dollar cost averaging into something goes down. So if you have a stock that's at $100, it goes to 90, you buy a little bit. It goes to 80, you buy a little bit. It goes to 70, you buy a little bit. Then you actually dollar cost average into that position. Once it hits the bottom of the market and starts increasing, all of a sudden you're seeing a lot bigger gains because you've been buying it as it was going down, which again, that is the reason why I automate all of my investments, guys. When it's going over to the VOO, when it's going over to cryptocurrency, it is bought every 2 weeks, regardless of the price is up or down. I am really spending the time in the market, which I have another probably 16 years. I would say 16 to 20 years before retirement. Now I know I am retiring in probably about 6 more years. It is the plan, but it's not so much a retirement as I'm never going to work again in my life. But it's going to be looking at something, doing something like YouTube, more of a consistent, more of a full-time basis, which is going to supplement everything that we have within the investments. And the final one we look at, guys, is the liquidity needs. You have to be really sure when you're looking at the long term that it's not money. You're not putting your emergency fund in the market. You're not putting your savings accounts in the market. Short-term funds are meant to be accessible. That is the savings accounts. You're not locking them up for a long duration, which would be greater than a year. Long-term investing, you can afford to lock up your capital. It is money that you are not going to need for an extended amount of time, which could include a couple years. So I hope, guys, that this video really helped define the short-term and long-term investments in the strategies that go along with it. So let me know in the comments what you guys think, and I'll catch you in the next video. When it comes to investing and having a specific timeline, you really need to break it down into the long-term and the short-term so you know exactly the investing strategy. Today's video, we're going to be doing just that, guys. We are going to break down the 10 topics for setting goals for the investment strategies. Now, these can be, again, very different depending on where you are in life. If you're a younger generation, you could be saving for retirement, you could be saving for purchasing a home, funding an education, or to achieve a certain level of wealth. If you're looking to have $500,000 or $1 million into an investment account prior to retirement, it is really up to you. Now, step number 1, guys, is setting these clear expectations or objectives of where you want to be. So looking at a retirement plan, you might just say, hey, I'm saving for retirement, but you need to specify and put a clear objective on how much money that you're going to plan or what you're planning for retirement. A lot of places do it by age. A lot of places do it by investments. But again, if you're saying you want to have, 50, 70, $100,000 in an account by a specific amount of time, if you're not moving towards and achieving that goal, you can increase the contributions in there. You can do a lot of different things if you have that very clear goal, getting to where you want to be with that investment. Number 2, determine your time horizon. Now, this is super imperative, guys, when it comes to, again, objectives like funding an education or purchasing a home. Right now, I have a 9-year-old, 18. She's probably going to be going to college, which means we don't have that many more years. If I am funding an education, how am I going to step it up, and how much money do I want in that education fund when she does turn 18 and go to college? Same can be said for purchasing a home. So let's say you're 18, you're 20, you're 22. You want to purchase a home, first-time home buyer, absolutely great. You're going to get a lot of credits and a lot of incentives in there, but you do want to save money for a down payment. It is imperative, guys, to make sure that you're saving money for a down payment. Now, if you're starting a job, you're getting, really beginning in your career, you might say, okay, well, then the next 3 to 5 years, I want to purchase a home. Or you could even say, in 5 years, I want to buy a home and I want to have X amount of money to put down on that home. That is, again, when you're going to plan that goal. If it's going to take you, $30,000 to have for a down payment, if you're breaking it over 3 years, you can figure out mathematically exactly how much you're going to need. Now, some of the longer term goals, guys, include that certain level of wealth and also retirement planning. Again, this can be it can be kind of put together based on your age. If you're a 20-year-old, the plan is going to look 100% different than if you're 40, 50, 60, so on and so forth, depending on what you want to have for retirement. Or it could even be as easy as budgeting in retirement. Guys, when you say, okay, I have X amount of money in a retirement account, how many years is that going to last me before I am completely out of money with the lifestyle I have? Again, this makes very, very important. Number 3, we get into the risk tolerance. Now, there's a risk associated with each goal. High risk means usually you can make it and get a little bit more of a return. This is very acceptable for long-term goals. Again, when you think of the stock market, when you think of things of that nature, longer term goals, meaning 10 plus years, it is going to be imperative that you do take high risk. And again, the younger that you are, the 20s, 30s, 40s, that is the time to take the higher risk, guys. When you're putting majority of money, and most of the plans even have 95 or 99% into the stock market at that point, because you have 10, 20, 30, possibly even 40 years until retirement, meaning that is the time to take the risk. When you look at the shorter term and the medium term, you really don't want to take such a high risk, because if it does go south, if some of these investments do go south, you are not going to have the time frame built in to get those gains back, or essentially recoup those losses that you've had with those investments. That's the time with, again, the short term or the medium term, that you really want to look at savings accounts. You want to look at CDs. You want to look at things of that nature to really set those targets. Number 4, we get into the quantifiable targets. This is a target specific amount or a specific down payment. This is setting it and breaking it down. This is, again, doing the math, guys, and figuring out what is going to be the most important in your life. Again, if you're planning in the next 3 to 5 years, you're buying a house, you know that is your target. You know what you need to get there. You just have to have the discipline to really sit down and make it happen. If that means, you're packing lunches instead of eating out, if you're cutting your date nights down, if you're cutting your trips down, even if you're going out, let's say you're not taking a vacation for those 3 years because you want to save every single penny. Once you move into that house, you put a hefty down payment down when you buy the house. Then you can go back and rebudget, really revisit everything, because your goal was actually to get into that house. Number 5, we get into the prioritization. This looks at the urgent and the important items. This helps to allocate your resources depending on determining which goal is going to be first, guys. This is a huge, huge part of it. Now, when I look at people that, get automobiles, most of them don't put anything down. Most people, first-time home buyers, they don't put anything down. That means that you are going to maximize your borrowing capacity, meaning that you're borrowing as much as you can. If you're buying a vehicle and it's $50,000, you are borrowing $50,000. Now, the flip side of that is, with the interest rates that we have today, you are going to be paying a ton when it comes to the interest in that vehicle. So not only would you buy a vehicle for, let's say, again, $50,000, current rate, you're paying $58,000, possibly even higher, depending on what term you have. Based on that, you're paying almost $10,000 more for the same vehicle than if you just bought it outright. You need to consider this, guys, because that is going to eat away. That monthly payment is going to eat away on all of the income that you have coming in, because you're going to have a ton going out for 5, 6, 7 years, depending again on the term you had. And with the interest running on there, you're paying, $8,000 to $10,000 additional for the vehicle that you're picking out. Number 6, we get into the income needs. This is another, again, very specific goal. Calculating the amount required for retirement income, to regular contributions, to contributions for a child's fund account. Exactly what is your target? Now, there are a ton of calculators online, guys, and you really want to stay ahead of the curve. I believe average retirement age at 64 looks about $140,000 to $180,000 at the age of 65. When you get there in the retirement years, that is about the average. You want to be well above the average, guys, because trust me, if you have $140,000 in a retirement account going into retirement, that is probably going to last about 7 years. Again, just mathematically speaking, with the amount you're going to spend, in healthcare, they say it's roughly around $17,000. but you have to build up that retirement account. And of course, the higher, the bigger, the faster you build out that retirement account, you are going to be subject to compounding interest, meaning you're going to get a lot more money out of there, especially if you're putting it into the Roth 401ks, putting it into the Roth IRAs. It is going to make a game-changing difference when you're stacking up those investment accounts and you're letting them run with compounding interest for a number of years. Number 7, we get into the regular review, guys. You have to review your goals, have to assess exactly where you are. Life circumstances will happen, financial situations will change. If you get a promotion, if you get a raise, if you get another job that is paying considerably more, that is the time to review it, guys. It is not the time, and I really stress this, it is not the time to go out and spend more money. It is not the time to get the bigger house, to get the bigger car, to take the extravagant vacations. That's the time that you need to buckle down and really know your priorities and know exactly what you want to do. If it means repaying debt, paying debt off, saving that 15% of your income, getting ready for college, and setting that money aside, paying off the house. Once you're debt free, guys, it is a whole entire lifestyle. Make sure you're reviewing this on a regular basis. Not only that, is just make sure the goals that you set for yourself are completely relevant. Life circumstances might have changed. You might have moved, from a rural area to a city like New York where it's incredibly expensive. Might make more sense to rent a place versus buying a place. Goals will change in life. Life has a way of really changing things and changing the circumstances that we have, but you can roll with the punches and really make the situations work by reviewing it regularly. Number 8, we get into the flexibility. Now, this is the adaptation for unforeseen circumstances. Again, things happen in life. There is different ways to adjust it. There are life events. All of a sudden you find out, you have somebody who passed away. You find out that someone is pregnant. You're getting married. There can be a ton of life events that are just game changers, guys, especially when it comes to unforeseen things that happen in life. And financial conditions will always involve. Even now, situations, a lot of people are caring for elderly parents, which is having a very big impact of the financial stability that people have. They're taking money out of retirement accounts. They're taking money out of savings accounts to support and really maintain the lifestyle for their parents because the parents didn't save enough money and now they're out of money when it comes into retirement. Number 9, we look at the tax consideration. Have to make sure, guys, the tax consequences. This is the reason why I really focus on the Roth versions of the 401k and the IRAs. These are huge when you're putting money in after tax, meaning you've already paid the tax, meaning when it grows, it will grow tax-free. There are age limitations. There are income limitations. Do your research, guys. Talk to your tax accountant. See exactly what you can do with these products because, again, 401ks have caps. IRAs have caps. They have income caps. They have contribution limits. There's a lot of different things, but again, focusing on and building out that Roth. The final one in here, guys, is the diversification of goals. This is really mixing the short term with the midterm, with the long-term goals, with a well-rounded approach, and really systematically coming up with one. Exactly. So if you have a short term, let's say it's the next 12 to 18 months, you want to take a vacation. How much money do you got to put away every single paycheck to make that happen? Medium term might be, again, the next 3 to 5 years that you're looking to purchase a new automobile or you're looking for a new house, or it could be 10 years plus with those long-term goals, meaning that you're looking at college educations or you're looking at retirement for yourself when it comes to building out these goals. So, all right, guys, so that is really setting and defining the 10 investment goals that you need to focus on. Let me know in the comments what you guys think, and I will catch you in the next video. So congratulations, you finally got the investment going. You're putting money in a regular basis, but what are you gonna do within a reinvestment strategy? What is your ultimate goal and things that you need to focus on? Today's video, we're gonna be breaking this down in a couple key points to really the reinvestment strategy and a couple different ways to look at this as you are getting dividends, as you are getting growth to really make the most of it. Number 1, we talk about the dividend reinvestment. Consider automatically reinvesting all of the earned dividends into the same investment, or you can actually utilize that to purchase additional shares of other ones. This strategy will accelerate the growth over time, meaning that if you have a share that is paying dividends, let's say you're buying the VOO, the dividends on that one are very low. Every time that I do get a dividend repayment, it is reinvested back into that portfolio. It might not go directly into the VOO because of the dynamic or the breakout of the portfolio, but anytime dividends are there, it is reinvested back into more assets. This, of course, is going to give us the 8th number of the world that we've talked about before. It is the compounding interest. So not only am I putting contributions into my investment account every 2 weeks, which is growing at an exponential rate, when I'm getting dividends, they are getting reinvested, allowing me to buy more shares. And also, when I'm growing that investment itself, as it's growing over time, I am getting more shares on top of, again, contributions, more shares, dividends, more shares. This can exponentially grow your investment faster than you can ever imagine, guys. Leveraging the power of compounding interest, reinvesting both the principal and any returns that you get from your stocks, it allows it to generate additional income over time, which you're going to utilize eventually, maybe, hopefully. I'm thinking that with some of the money that we do have invested, it could be money that is going to be passed down generational wealth, or building out a stock portfolio where it's going to be the point it generates enough income on a regular basis that you never have to touch the initial principal because you have more than enough to take off of the compounding interest. So you think about it, if you have $1 million stock portfolio, you're yielding 5% every year. You can take $50,000 off of that every single year. Using that $50,000, you could buy more, you could buy other things, you could invest in elsewhere, but you would still have the $1 million that you originally started with, depending on what the investment is. Now, again, if you grow this, let's say we leave our 50,000 in there. Now you got $1,050,000. Now it's going to grow a little bit more than that 50K the following year if you're staying at that 5%. The compounding will continue from there, guys, which is kind of crazy. Now you leave that in there for 5, 10, 15, 20 years. All of a sudden, you have a crazy amount of income just from that compounding interest. Number 3, we look at the diversification. When using a diverse portfolio, which we talked about in our last video, reinvesting funds can be allocated into different asset classes or even different sectors. Now, this, of course, you take the dividends out. When you receive the dividends, you reinvest them into something else, whether it is another sector, if it is another aspect. Let's say you have money in the stock market and you're putting all your dividends into bonds. You have your investments there, and then you're using some of it for REITs. You're using some of it for, fine art through Masterwork. There could be a plethora of ways that you could use the dividends that you're getting, not only just to reinvest, guys, but you could look at other avenues that you can use the money. With that comes the tax investment or the efficiency reinvestment strategy, guys. Utilizing tax efficiency, which talk to your tax advisor 100%. You can reinvest a lot of it for tax advantaged accounts. This is the reason, again, why I focus on the Roth 401ks, the Roth IRAs, is if you're keeping the money in there, it will grow tax-free. When you take the money out in the future, it will be tax-free. That is the big thing, guys. When you're taking money out of a regular 401k or a traditional Roth, you're getting the benefit up front to pay taxes later. Well, if you compound, again, 20, 30, 40 years of growth on that compounding return, when you take out, now you're getting taxed on everything you had in there. Number 5, emergency fund contributions. If your investment portfolio does pay out, guys, this could be the ability to build an emergency fund, 3 to 6 months of savings, or replenish an emergency fund if you need to. So essentially taking some of the dividends, reallocating it to another thing, like to cover an unexpected expense or safety net, whatever you have going on, guys, to really fund the things you want to do in life. Number 6, huge one, debt repayment. You should not be investing, guys, if you do not have a debt repayment plan. My personal opinion, similar to what Dave Ramsey teaches, debt should be the priority number 1. There's not a place, not very many places at all, that you are going to get a higher return than carrying debt. When you look at auto loans, even 6.5%, 7% currently. When you look at a lot of equity lines, they're about 9%, unsecured debt, 9% plus. Even when you look at credit cards, 20, 22, 24%, you're not going to find these kinds of return, guys. Once you pay down that debt, once you pay off that debt with a debt repayment strategy, go ahead and put a lot more towards investment. All of a sudden, if you don't have debt, you have a lot of money to invest, and the compounding can come a lot quicker. Number 7, we look at the opportunistic investments. This is looking at anything that is undervalued, taking advantage of the market downturn. If you look at 2022, we were down about 20+% in a lot of the portfolios, which means if you had money on the sidelines, if you were sitting in cash, or if you're sitting in other assets, it would be an amazing buying opportunity. Personally, I do the dollar cost averaging, which means every 2 weeks I do invest in the stock market. With that investment, I literally drove and bought the stock market the entire time that it went down. Then when it rebounded into 2023, dollar cost averaging worked for me incredibly well because I seen a lot of gains for everything that I bought while the market was going down, and even all the gains that I seen when I bought at the very bottom of the market in 2022. Works incredibly well, guys. It pulled me up about 30+% this year just utilizing the dollar cost averaging. Number 8, we get into the education and skill development. It is really investing in education, investing in yourself will always pay dividends, guys, which it will be incredible. So even if you take some of the dividends from the reinvestment or the investment portfolio, personal professional development will increase your potential earning and your financial well-being. The more time and effort that you spend in the financial education, financial literacy, the better that you will be making smart decisions when it comes to investing, when it comes to borrowing, when it comes to finances altogether. You have to make sure, guys, that that piece is built in. The education piece is there fundamentally. If you start investing, guys, start with 10 bucks, 50 bucks, 100 bucks. It's not a place you're going to start putting thousands of dollars in until you have a really sound strategy. Sit down with someone, review it, make sure it is the best option. The next one we look at, guys, is systematic investing. This is really what I talk about when it comes to dollar cost averaging. There's a lot of different ways that you can do this. A lot of people will sit money on the sideline till the market drops, and then they'll go ahead and put that in. Dollar cost averaging, of course, is the regular reinvestment of a fixed amount every single time. You could even look at this a little bit differently, meaning that you could do value investing, you could do dollar cost averaging, you could do a ton of different ways. So let's say, for instance, you have $200 that you invest every 2 weeks into the stock market. You're going to cut that in half, do $100 every single time that you get paid. So instead of putting the 2, you're only putting the 1. Your other 100 is sidelined from the pay. Your dollar cost averaging into every position with your $100 that you're putting in there. But then when you see a drop in the market, you will have money set aside in a savings account that you can actually look at the value cost and buy a bigger bulk majority instead of dollar cost averaging in. You could actually do both. But again, the time and effort that it takes to figure out what strategy you're using, that is the reason why I do simplify. That's the reason I stay with ETFs. That's the reason why I stay just with dollar cost averaging, because you can split it 50 different ways, guys, and it becomes incredibly complex if you make it complex. And the final one we look at, guys, is the retirement savings. This is the IRAs. This is the 401ks. This is any of the accounts that you're going to build up a really big portfolio and a nest egg, taking advantage of all the tax benefits, which I said again, the Roths, guys, they are the way to go. It is going to grow over your entire lifetime, completely tax-free. And you know what? When you start putting 15% into that retirement account, when you get raises in the future, when you get promotions, when you get bumps, whatever it may be, you are already going to have 15% invested. So you don't even have to alter that plan because you already know you're capped where you need to be. Guys, that'll do it for today's video. Let me know what you think about the reinvestment strategies, and I'll catch you in the next video.